If you're storing gold in a safe right now, what I'm about to share could change everything you thought you knew about protecting your wealth. Because while you think that metal is secure, sitting there in your home or safety deposit box, there's a danger most people never see coming, and it's not what you think. See, the real threat isn't theft. It's not even confiscation, though we'll get to that. The danger is far more insidious. It's the silent erosion happening right now, while your gold sits idle, and the opportunity cost that's mounting with every passing day. Let me explain what's really going on. Gold is trading near all-time highs across every major currency. The metal has been on an absolute tear, and central banks worldwide are accumulating at record pace. But here's what nobody's talking about. While your gold sits in that safe, it's not working for you. It's not generating income. It's not compounding. And in an environment where inflation is still running hot, that matters more than most people realize. Think about it this way. You bought gold as insurance, right? As a hedge against the system. Smart move. But insurance only works if it's structured properly. And here's where most people get it wrong. They buy physical gold, stick it in a safe, and think they're protected. But they're missing three critical vulnerabilities that could cost them everything. First vulnerability, liquidity. When you need to access that wealth quickly, what's your plan? You've got to physically retrieve the gold, find a reputable buyer, negotiate a fair price, and hope you're not getting taken advantage of in a moment of desperation. I've seen people forced to sell gold at steep discounts because they needed cash fast and didn't have time to shop around. That's not a position you want to be in. Second vulnerability, verification. How do you know what you have is real? I'm not questioning your purchase, but the counterfeit market for gold has become incredibly sophisticated. Tungsten-filled bars that pass basic tests. Coins with the right weight but wrong composition. Unless you're testing your gold regularly with expensive equipment, you're trusting that what you bought years ago is what you think it is. And when it comes time to sell, buyers are going to test it. What happens if there's a problem? Third vulnerability, and this is the big one, tax efficiency. When you sell gold you've held in a safe, you're paying capital gains taxes on the profit. And gold is classified as a collectible by the IRS, which means you're looking at a maximum tax rate that's higher than stocks or real estate. So if you bought gold years ago and it's appreciated significantly, you could be handing over a substantial chunk of your gains to the government when you finally sell. Now, before we go further, I want to share something with you. I've put together a free guide that breaks down the wealth protection strategies thousands of American retirees are using right now. It's in the description below. No cost, no obligation, just solid information about how to structure your assets in a way that actually protects you. Grab that while you're thinking about this. Let me tell you what's happening behind the scenes that makes this moment so critical. Central banks added over 800 tons of gold to their reserves in a recent 12-month period. That's the highest level of buying we've seen in decades. The People's Bank of China has been accumulating month after month. The Reserve Bank of India is buying. Poland, Singapore, Turkey, they're all loading up. These aren't small purchases. These are strategic moves by institutions that have access to information and analysis that would make your head spin. Why are they doing this? Because they see what's coming. The dollar's dominance as the global reserve currency is being challenged in ways we haven't seen since Bretton Woods collapsed. The BRICS nations are actively working on alternative payment systems. Saudi Arabia is now accepting yuan for oil sales. The entire architecture of global finance is shifting, and gold is positioning itself as the ultimate neutral reserve asset. But here's what's fascinating. While central banks are buying physical gold and storing it in vaults, they're not just sitting on it. They're using it as collateral. They're leveraging it in the international monetary system. They're making their gold work for them. And that's the key insight most individual investors miss. Your gold in a safe is dead money. It's not participating in the system. It's not generating returns. It's just sitting there, hoping to appreciate. And yes, it probably will appreciate over time, but you're missing out on the strategic advantages that come from having your gold properly positioned within the financial system. Let me paint you a picture of what's happening in the physical gold market right now. The spreads between paper gold and physical gold have been widening. What does that mean? It means the price you see quoted on financial networks, that's the paper price, the price of contracts and ETFs. But when you go to actually buy physical gold, you're paying a premium above that price. And when you go to sell, you're getting less than that price. That spread is the friction cost of holding physical metal, and it's been growing. Meanwhile, the COMEX, the major exchange where gold futures trade, has been seeing some interesting dynamics. The amount of gold actually available for delivery has been declining relative to the open interest in contracts. Now, most futures contracts never result in physical delivery. They're settled in cash. But the ratio matters because it tells you about the stress in the system. And right now, that ratio is suggesting there's more demand for physical gold than the system can easily supply. You know what that reminds me of? It reminds me of what happened in the silver market back when the Hunt brothers tried to corner it. Now, I'm not suggesting anyone's trying to corner gold. The market's too big for that. But the principle is the same. When you have more claims on physical metal than there is metal available, something's got to give. Either prices go up or the system changes the rules. And we've seen both happen throughout history. Here's another angle most people don't consider. The mining supply of gold is relatively fixed. It takes years to bring a new mine online. Exploration, permitting, construction, it's a decade-long process in many cases. And the easy gold has already been found. New discoveries are deeper, lower grade, more expensive to extract. Meanwhile, demand is surging, not just from central banks, but from technology, from jewelry, from investors. The supply-demand fundamentals are tightening in a way we haven't seen in years. But let's get back to your gold in that safe. Here's a scenario I want you to consider. Let's say there's a major financial crisis. Markets are crashing. Banks are in trouble. This is exactly the scenario you bought gold for, right? You're protected. Except, what happens when you need to convert that gold into usable currency to pay bills, buy food, handle emergencies? You're going to have to find a buyer in the middle of a crisis. And in a crisis, liquidity dries up. Buyers become scarce. Spreads widen dramatically. You might have to accept far less than fair value just to get cash in hand. I've talked to people who lived through the financial crisis. They had gold. They thought they were safe. But when they needed to access that wealth, they found it was harder than they expected. Local coin shops were overwhelmed. Online dealers had long delays. Some people ended up selling to pawn shops at terrible prices because they were desperate. That's not a theoretical risk. That's what actually happens when the system is under stress. Now, I'm not saying don't own physical gold. I'm saying think about how it's structured. Think about accessibility. Think about liquidity. Think about tax efficiency. Because there are ways to own gold that give you all the benefits of physical ownership without the vulnerabilities I just described. And this is where it gets interesting. Because the financial industry has created structures that allow you to own gold in a way that's actually more secure than a safe, more liquid than physical coins, and more tax efficient than holding it personally. I'm talking about gold held in qualified retirement accounts, gold IRAs. Now stay with me here because this isn't a sales pitch. This is about understanding your options. Here's how it works. You can roll over funds from an existing retirement account into a self-directed IRA that holds physical gold. The gold is stored in an IRS-approved depository. It's fully insured. It's segregated in your name. You own it. But it's held in a structure that gives you significant advantages. First, it's liquid. You can sell it with a phone call and have cash in your account in days. Second, it's verified. The depositories test and certify the gold. No question about authenticity. Third, and this is huge, it grows tax-deferred or tax-free depending on the account type. No capital gains taxes eating into your returns. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide specifically on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties, what the rules are, what the costs look like. Worth checking out if that's relevant to your situation. No pressure, just information. Anyway, back to why this matters right now. We're in a unique moment in financial history. The Federal Reserve has been trying to manage inflation while keeping the economy from tipping into recession. It's a tightrope walk, and historically, they don't stick the landing. Either inflation stays elevated and erodes purchasing power, or they tighten too much and trigger a downturn. Either scenario is bullish for gold, but the way you hold that gold determines whether you actually benefit or just watch from the sidelines. Let me tell you about something that happened during the last major gold bull market. This was back when gold went from a few $100s to over 1,900. People who owned physical gold made money, sure, but people who owned gold in tax-advantaged accounts made significantly more because they weren't paying taxes on the gains along the way, and when they eventually took distributions, they did it strategically to minimize the tax hit. That's the difference between being smart about wealth protection and just hoping for the best. Here's another thing to consider. The government has a history of changing the rules when it comes to gold. In 1933, Executive Order 6102 required citizens to turn in their gold. Now, could that happen again? Most experts say no. The circumstances were different. The dollar was backed by gold then. It's not now. But the point is, governments do desperate things in desperate times. And if you're holding physical gold in a safe, you're exposed to that risk in a way that gold held in certain qualified accounts might not be. I'm not trying to scare you. I'm trying to get you to think strategically, because the people who do well in times of financial stress aren't the ones who panic. They're the ones who positioned themselves correctly before the crisis hit. They're the ones who understood the rules of the game and played accordingly. Let's talk about what's happening in the bond market right now because it's directly relevant to gold. Treasury yields have been volatile. The yield curve has been inverted, which historically signals recession. Foreign buyers of U.S. debt have been pulling back. China has been reducing its treasury holdings. Japan, traditionally a huge buyer, has been selling to support the yen. Who's picking up the slack? The Federal Reserve. Through quantitative easing, they're printing money to buy bonds. And every dollar they print dilutes the value of existing dollars. That's inflation. That's why gold goes up. But here's the nuance. Gold doesn't just go up because of inflation. It goes up because of uncertainty, because of loss of confidence in the system. And right now, confidence is fragile. You see it in the volatility. You see it in the flight to safety. You see it in the fact that gold is hitting record highs in multiple currencies simultaneously. That's not normal. That's a sign that something fundamental is shifting in the global financial system. Think about the geopolitical situation. We've got tensions between major powers at levels we haven't seen in decades. We've got supply chain disruptions that exposed how fragile our just-in-time economy really is. We've got energy markets that are being weaponized. We've got food security concerns as climate and conflict disrupt agriculture. These aren't temporary problems. These are structural shifts that are going to define the next decade. And in that environment, hard assets like gold become increasingly important. But again, it's not just about owning gold. It's about owning it in a way that protects you from all the angles. Legal protection, tax protection, liquidity protection, verification protection. These things matter. And the difference between doing it right and doing it wrong could be tens of thousands of dollars or more over the course of your lifetime. I want to share a story with you. I know someone who inherited a substantial amount of gold coins from their parents. Beautiful coins, rare dates, significant numismatic value on top of the gold content. They kept them in a safe deposit box at a bank. Then the bank got acquired. The new bank changed policies. They had to move the coins. During the move, some went missing. The insurance claim was a nightmare. They eventually got paid, but it was for the gold content only, not the numismatic value. They lost tens of thousands of dollars because of how the gold was stored. Now contrast that with someone who has gold in a qualified account at a reputable depository. The gold is insured for full value. It's audited regularly. It's segregated and identified specifically to their account. If they want to take physical possession, they can. But while it's in the depository, it's safer than almost anywhere else they could keep it. And they're not paying capital gains taxes on the appreciation. That's the difference between hoping for the best and actually being protected. Let's talk about the mechanics of the gold market for a minute, because understanding this will help you see why positioning matters. The London Bullion Market Association, the LBMA, is where most of the world's gold trading happens. It's an over-the-counter market where large institutions trade gold in 400-ounce bars. These aren't coins you can hold in your hand. These are massive bars that require special handling. And the price you see quoted, that's the LBMA price. But when you buy coins or small bars, you're paying a premium above that price. When you sell, you're getting less than that price. That spread is the cost of being in the retail physical market. Now, There are ways to own gold that track the LBMA price much more closely, ETFs for example. But ETFs have their own issues. You don't own the physical gold. You own shares in a trust that owns gold. If there's a crisis and everyone tries to redeem at once, what happens? The trust might have to sell gold to raise cash, which could depress the price right when you need it most. Plus, you're paying management fees every year. Those fees compound over time and eat into your returns. The sweet spot, in my opinion, is physical gold held in a qualified account. You own the actual metal. It's allocated to you specifically, but it's held in a structure that gives you institutional level advantages. You're not paying the retail spreads. You're not worrying about storage and security. You're not dealing with the tax complications, and you have liquidity when you need it. Here's something else to consider. The industrial demand for gold is growing. It's not just jewelry and investment anymore. Gold is used in electronics, in medical devices, in aerospace, in green energy technology. Solar panels use gold. Electric vehicles use gold. As we transition to a more electrified economy, industrial demand for gold is going to increase. That's a fundamental support for the price that has nothing to do with monetary policy or geopolitics. It's just supply and demand, and the supply side is constrained. Gold mining is a mature industry. The big, easy deposits have been found and exploited. New discoveries are smaller, deeper, lower grade. It takes more energy and more money to extract each ounce. That puts a floor under the price. Below a certain level, mines shut down because they're not profitable. That floor has been rising over time as costs increase. So you've got growing demand and constrained supply. That's a recipe for higher prices over the long term. But short term, gold can be volatile. It can pull back sharply when the dollar strengthens or when real interest rates rise. That's why you don't want to be forced to sell at the wrong time. You want to own gold as a long-term strategic holding, not as something you might need to liquidate in a panic. And that's another advantage of having it in a retirement account. You're not going to need that money for years or decades. You can ride out the volatility and let the long-term fundamentals work in your favor. Let me tell you about what happened in 2008. Gold was around $800 an ounce when Lehman Brothers collapsed. Within 3 years, it had more than doubled. People who owned gold did well, but people who owned it in the right structure did even better. They weren't paying taxes on the gains. They weren't worried about liquidity. They just watched their wealth grow while everything else was falling apart. That's the power of being positioned correctly before the crisis hits. And here's the thing. We might be in the early stages of a similar setup right now. The debt levels are higher than they were in 2008. The Federal Reserve's balance sheet is massive. The banking system is more concentrated and potentially more fragile. The geopolitical risks are greater. And gold is already at all-time highs, which tells you the market is pricing in significant future uncertainty. This isn't the time to be complacent about how your wealth is structured. I want to address something that comes up a lot. People say, but I want to be able to hold my gold. I want to know it's there. I get that. There's a psychological comfort in physical possession. But ask yourself this, is that comfort worth the risks and costs? Is it worth the liquidity risk, the verification risk, the tax inefficiency, the security concerns? For some people, maybe it is. But for most people, especially those with significant wealth and retirement accounts, there's a better way. Think about it like this. You probably don't keep all your cash under your mattress, right? You keep it in a bank because it's safer, more convenient, and it can earn interest. The same logic applies to gold. Yes, you could keep it in a safe, but keeping it in a qualified depository gives you all the benefits of ownership with none of the headaches. And in a retirement account structure, you get the tax advantages that can make a massive difference over time. Here's a real-world example. Let's say you bought gold years ago, and it's appreciated significantly. If you sell it now, you're paying capital gains taxes on the profit. Depending on your tax bracket and how long you held it, that could be a substantial hit. But if that same gold was in a traditional IRA, you wouldn't pay taxes until you took distributions. And if it was in a Roth IRA, you might not pay taxes at all. That difference compounds over time and can mean hundreds of thousands of dollars more in your pocket. Now, I know what some of you are thinking. This sounds complicated. I don't want to deal with the paperwork and the rules. And I hear you. But here's the reality. The paperwork is a one-time thing. Once the account is set up, It's actually easier to manage than physical gold. You're not worrying about storage. You're not worrying about insurance. You're not worrying about finding a buyer when you want to sell. It's all handled for you, and the tax advantages alone make it worth the initial effort. Let me bring this back to the title of this video. If you have gold in your safe, the danger isn't that someone's going to steal it. The danger is that you're not maximizing the protection and growth potential of that asset. You're exposed to risks you might not have considered. You're missing out on advantages that could significantly improve your financial security. And in a world that's becoming increasingly uncertain, that's a risk you can't afford to take. So what should you do? First, educate yourself. Understand your options. Understand the pros and cons of different ways to hold gold. Second, think about your overall financial strategy. What are you trying to accomplish? What are your time horizons? What are your liquidity needs? Third, consider whether restructuring how you hold gold could give you better protection and better returns. And fourth, talk to professionals who specialize in this area, not salespeople, not people who are just trying to sell you something, but people who can give you objective advice based on your specific situation. And speaking of that, for those of you who've stuck with me this far, I want to offer you something special. In the description below, there's a link to that free guide I mentioned. But if you're an American retiree with at least $100,000 in any retirement account, you also qualify for a complimentary one-on-one educational web conference. No obligation, no sales pressure, just a chance to talk through your specific situation with someone who knows this space inside and out. It's only available to people who mention they watched this video, so make sure you bring that up when you reach out. Look, I'm not here to tell you what to do with your money. That's your decision. But I am here to make sure you have all the information you need to make an informed decision. Because the financial landscape is changing rapidly. The rules are different than they were 10 years ago. The risks are different, the opportunities are different. And the people who do well are the ones who adapt to the new reality instead of clinging to old assumptions. Gold has been money for thousands of years. It's survived the fall of empires, the collapse of currencies, wars, depressions, and every other crisis humanity has faced. It's going to survive whatever comes next. The question is, are you positioned to benefit from that survival? Or are you just hoping that the gold in your safe will somehow protect you when the time comes? Because hope is not a strategy. Hope is what people do when they haven't thought through the details, when they haven't considered all the angles, when they haven't positioned themselves for success. And in times of financial stress, hope is expensive. It costs you opportunities. It costs you security. It costs you wealth. The smart money isn't hoping. The smart money is acting. Central banks are acting. Institutional investors are acting. High net worth individuals are acting. They're repositioning their assets for what's coming. They're making sure their gold is working for them, not just sitting idle. They're taking advantage of every legal structure and tax benefit available to them. And they're doing it now, before the next crisis hits, because they know that's when it's too late. So take a hard look at that gold in your safe. Ask yourself if it's really protecting you the way you think it is. Ask yourself if there's a better way. Ask yourself if you're willing to make a change that could significantly improve your financial security. Because the opportunity is there. The structures exist. The benefits are real. All you have to do is take action. And remember, this isn't about being scared. This isn't about panic. This is about being smart. This is about understanding the game and playing it well. This is about taking control of your financial future instead of leaving it to chance. That's what separates people who thrive in uncertain times from people who just survive. And right now, with everything that's happening in the world, with all the risks and opportunities in front of us, that difference matters more than ever. Your gold is valuable. Make sure it's working as hard for you as you work to acquire it. Make sure it's structured in a way that maximizes protection and minimizes risk. Make sure you're not leaving money on the table because of how you're holding it. That's the real danger. Not theft, not confiscation, but missed opportunity and unnecessary risk. And now that you know, you can do something about it.